A major country is collapsing. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, this country will bring the global economy down with it, and why it means another financial crisis is coming. Plus, we have a sponsor for today's show who's focused on the treatment and prevention of cancer, and we're going to show you why we think their stock can make a huge 65% move to the upside. Stay tuned to the end of the show or check out the pinned comment or description below for more information. Now let's go to Bloomberg, where we picked today's story up with a headline: China slides to the brink of deflation, adding stimulus urgency. You know, it's amazing that not long ago we've heard about too much stimulus around the world, from fiscal and monetary, and now all of a sudden in China we're getting more and more calls for stimulus. The question is, why are they doing it? Well, what you're seeing is one of the largest economies in the world, the biggest exporter in the world, their economy is slowly collapsing, and the only way the experts believe you can prevent it from happening is more stimulus. Let's take a look why. The consumer price index was unchanged last month from a year earlier, according to data released on Monday. That was the weakest rate since February of 2021, when slumping pork costs dragged the index down. Core inflation, which excludes volatile food and energy costs, also slowed to 0.4% from 0.6% the prior month. Producer prices even fell 5.4% from a year earlier. Get this, the deepest pace since December of 2015. The risk of deflation is real. And you start to think about, wait a minute, we went from just ridiculous numbers of inflation. Now we're hearing talks about deflation. We've got the U.S. Consumer Price Index coming here this week. The question is, why is this a problem? Because what a lot of people don't understand, when you see slowing consumer prices or even deflation where they're going negative, well, it's a sign the economy is slowing. And when you see this from the world's largest exporter, now keep in mind, this is where demand starts in the world. So if there are new orders, where do a lot of them go? They go to China. So if you're seeing problems in China, it tells you there's big problems around the rest of the world. And if China goes down, well, everyone else will soon follow. And here we can see the effects of consumer price index. Now we're looking at the U.S. CPI here, shown on a year-over-year rate of change. And again, we'll get an update on this here in a couple of days. But what's notable is you typically see an expansion. So that's the white area, where inflation is generally trending higher. You can see down here in 1986, it kind of slumped but quickly rebounded. But notably, here you see in the course of the early 90s recession, what happened? Consumer prices went down. And then you kind of see here during the expansion, following, everything was okay. There was a little slowdown there in the kind of late 90s. Inflation came back, then all of a sudden came crumbling down into a recession. Again, this is a sign demand is weakening, not exactly what you need to see if you're hoping for a global economic recovery. Again, it happened during the global financial crisis. Here you see inflation coming down when we almost had a global recession around 2015. There's the evidence of it. You've got the pandemic, and now we're seeing it again. So all we're seeing here in China is giving us a leading indicator of what's coming to the rest of the world here. And what it's telling us is not just the Chinese economy is slowing, not just the U.S. economy is slowing, the entire global economy is simultaneously slowing, and China's leading the pace, which is a huge problem. Both gauges add to evidence that the recovery is weakening, as we've made the case, with concerns about deflation weighing on confidence, and that's likely to spur more speculation about what potential stimulus may be in the cards to shore up in the economy. So why are we all of a sudden going from too much stimulus to now, wait a minute, maybe we need more stimulus? It all comes back to how debt-based economies work. So in a debt-based economy, debt fuels economic growth. Well, in periods of deflation, what happens is wages are usually starting to go down, people are losing their jobs, and you have a period where there's generally a very high debt load coming out of the prior expansion. And next thing you know, if there's not money to service that debt, you start to get delinquencies, you start to get defaults, because again, in a debt-based economy, you need a constant expansion of debt. You need to see the economy growing. Deflation is a sign the economy is contracting, and of course that means governments need to run to stimulate, or you have an all-out financial crisis on your hands. Producer prices sank 5.4% in June from a year earlier and slipped, get this, 0.8% from a month ago. That's huge. This was weaker than a Reuters poll has expected, compared with the 4.6% annual decline in May. The annual decline in June was China's 9th consecutive drop, and again, its steepest since December 2015. Now, why do producer prices in China even matter to anyone? Well, it's simple. Here in America, when we go to the store and buy things, where are they generally produced in? They're produced in China. So that's why you see, if producer prices in China are coming down, or in this case contracting on a year-over-year rate of change, what does that tell us is coming for U.S. consumer prices? Well, if you said they're headed negative, you got it. The producer price deflation was fueled by extended drops in international commodity prices, and aside from a brief period of deflation in early 2021, China hasn't experienced prolonged consumer price deflation, get this, since 2009 amid a global financial crisis. So here we're seeing already the seeds being sown, not only for a globally synchronized recession, which would be bad by itself, but a whole financial crisis. Because you start to think back during the pandemic, what happened? There was massive amounts of debt taken. We've seen it in the credit card data. People are borrowing a ton of money. Next thing you know, the global economy slows, and all of a sudden you have this game of musical chairs where there's never enough money to pay on the debt. Well, the problem is in deflation, you're not creating hardly any money now. You're arguably destroying money. And next thing you know, a lot of people are finding themselves, when the music stops, without a chair, into delinquency and eventually default. And here we can see just how critical China producer prices are to U.S. Consumer Price Index. Now, this is the available data from the PPI in China based on the data available in the St. Louis Fed database. So it's actually minus 6.5%. So it's way down here somewhere. But look at this nonetheless. In red, we have China's producer prices, in blue, U.S. consumer prices. And what do we know? Where China's producer prices go, the U.S. consumer prices follow. And this is critical. You're seeing it happen now at a time that everyone believes, including the Fed, that they're going to keep raising rates to bring inflation down. We're going to get, again, another CPI print here this week, which should show the year-over-year rate change and U.S. consumer prices head even lower. And it won't be long before we get to the Fed's target. And based on what we're seeing out of China's producer prices, we're going to blow right through 2% to the downside. And looking forward, China to extend policies to support alien property market. So it wasn't long ago we had this big problem in the Chinese real estate market. Now we've got a problem in the U.S. commercial real estate property market. And I want you to see the similarities here, because there's some very interesting ones going on. Financial institutions, get this, will be encouraged to negotiate with real estate firms to extend outstanding loans in order to ensure the delivery of homes under construction. Now, I want you to remember, it was just last week we talked about the commercial real estate problem here, and what did we hear from the policymakers who are allegedly watching this with eagle eyes to make sure, well, they have no clue what they're looking for, but they're just hoping nothing goes wrong. And what did they recommend to the banks? Hey, you need to extend credit or do some more things with additional borrowing and make sure that these loans don't go into default. Here we're seeing the same response out of China. Some outstanding loans, including trust loans due before 2024, will be given a one-year repayment extension. This coming from the People's Bank of China and the National Financial Regulatory Administration. Give people more time and maybe things will get better. China's two-year real estate crisis is stifling a recovery in the world's second largest economy, fueling expectations for the government to take more steps to revive demand. Here we go, revive demand, validating demand is coming down. Home sales resumed declines in June following a brief rebound earlier this year, adding to pressure on debt-laden developers. Now, the issue here is, why aren't people buying real estate? Well, if you live and work in China and you're seeing producer prices go negative on a year-over-year rate of change, and you're seeing global demand come down because your factory's not as busy, you're certainly not going to run out and buy a whole lot of real estate. And China's economy is really keyed on the expansion on the internal side of China's economy on its real estate sector, suggesting, again, a financial crisis brewing, not here in just here in the U.S., but also in China. Besides the property market, other facets of the economy are also showing weakness. Consumer spending is sluggish, exports are flagging, and local government debt is soaring. All bad things boding for a big financial crisis. Data today showed the nation's consumer inflation rate was flat in June, while factory gate prices fell further, as we've noted, deepening deflation concerns and adding to the evidence the recovery is weakening. It's not just adding to, it's validating that the recovery is weakening. And where China goes, as I said, they're going to bring the whole world down with them, and that means the U.S. too. Let's take a look here at China's GDP growth against the U.S. When China falls, well, the rest of the world's not too long behind them. Here we can see in red the gross domestic product for China against the U.S. real gross domestic product. And again, both these shown on a year-over-year rate of change. Here you can see when the red is heading down. Now, China's economy moves around a lot, and you can see it heads down and leads the U.S. economy in blue following. Here you can see it comes down, and U.S. economy quickly following it into recession. Here you can see kind of in the mid-70s into the early 80s, China's having some problems. The U.S. economy slows. You see it again in 85. You hear again in around 94 to 95. It puts some downward pressure that eventually gets into that dot-com bubble. Here you see the global financial crisis. Again, China saw it coming first. Pandemic, they knew it first. And of course, now they're leading the way as well. Stress in the property industry flared up this week after one state-backed developer saw its bonds tumble on concerns over its debt load, while another defaulter failed to find a buyer for $1.8 billion project at a forced auction. And here we can see, according to the housing market there, according to a leading builder, is, quote, worse than expected. And now Goldman's projecting a higher default rate for Chinese high-yield property dollar bonds. So again, you're all sowing the seeds for not just a global recession, for a financial crisis from too much debt and an overemphasis by central bankers that inflation needs to get down to the point where they've stifled credit growth, where we're going to see outright deflation. And of course, again, not enough money going around to pay all the debt, and you can just see it's all going to come due all at once. And Yellen, of course, our favorite Treasury Secretary, headed over to China to patch things up amidst big problems between the two countries, as China's trip offers economic guardrails for the rivalry. We seek to diversify, she said, not decouple. I've heard my Chinese counterparts express skepticism about decoupling, and I've expressed some concern that de-risking amounts to decoupling, and I felt that it was extremely important for me to address this issue. Now, what did we learn during the pandemic? Is too many businesses, too many things, according to the U.S. as well, a lot of intellectual property being used there, national security stuff, and all of a sudden there's this idea that, hey, maybe we shouldn't focus too much on China. Maybe there's some risks here. If they have another outbreak, they're going to lock their country down, and that's going to drive manufacturing down, cause inflation. We need to de-risk, kind of spread our risk apart. And of course, that's what Yellen was there to do. Of course, we know what China was there to talk about. During Yellen's visit, the Chinese side asked the U.S. to take concrete actions to address concerns over economic sanctions and containment. The Chinese side also reiterated its concerns about issues, as I've said, this is coming, including tariffs, export controls, and a ban on products produced in Xinjiang, according to the statement. Of course, we know the issue there, and I'm sure I pronounced that province wrong, but beyond that, the issue here is if you're the world's largest exporter, what you don't want is tariffs and export controls put on your goods and services. It causes major problems. But is it too late for the country already? Well, one expert says it's over. Richard Koo on China's risk of a Japan-style balance sheet recession. The question is, can China fight off its debt overhang? And he says, no, they can't. And what the Chinese economists are worried about is that China may be falling into what I call a balance sheet recession. And a balance sheet recession is triggered by this whole notion that people feel uncomfortable with their balance sheets. Suppose their debt is too large relative to their assets, and that typically happens after bursting a bubble, which you can see happening right now. If the bubble is financed with debt and asset price collapse, but the liabilities remain, people realize that their balance sheets are underwater, and if their balance sheet is underwater, you have to fix it. So you start to see is this is what's happening in China. Well, it's not just there. You're going to see this happen in the U.S. because there's a massive amount of debt into a slowing economy. At some point, people realize that, hey, the slowing economy can affect me too and affect my family. Better prioritize paying off debt instead of spending. And how do you fix it? He says, well, you pay down debt. Well, that's the right thing to do at the individual level, but when everybody does this all at the same time, we get into a fallacy of composition problems in that and national economy. If someone is saving money or paying down debt, you need someone else to borrow and spend the money to keep the economy going, and next thing you know, you spiral into a deflationary crash. And so you can now see how we started the show out, that China is going to drive the global economy down and is going to trigger a financial crisis with it. But one thing we are optimistic on, and that is our sponsor for today's show, Anixa Biosciences, who's focused on the treatment and prevention of cancer. Now, you can find more information on them in the description below and the pinned comment. We've got everything you need. You can find them on the NASDAQ, symbol ANIX. Anixa Biosciences is developing therapies and vaccines that are focused on critical unmet needs in oncology. Their programs are using the body's immune system to take multiple approaches in fighting cancer. Their CAR-T cell therapy to treat cancer and vaccines to prevent cancer. And according to their therapeutic side, they're developing a chimeric antigen receptor, a T-cell or CAR-T based immunotherapy drugs, which genetically engineer a patient's own immune cells to fight cancer. Plus, they're also developing a revolutionary vaccine technology focused on preventing breast cancer, as well as using a similar mechanism as their breast cancer vaccine to develop a vaccine to prevent the occurrence of ovarian cancer. Now remember, they are on the NASDAQ, symbol ANIX, and we'll show you here in a bit just how we think you can trade their stock to a 65% move to the upside. Let's take a look at some of their investment highlights, because Anixa is a clinical stage company collaborating with the world-renowned institutions to develop first-in-class products to prevent and treat serious large market diseases. They've got a highly diversified oncology pipeline. They're currently running 2 clinical trials. They've got a huge marketplace. If their trials are successful, there is a ton of people that are going to buy it. They've got some key partnerships we'll look at in a moment, and a strong financial position that means they don't need to sell stock to raise cash. And here their strategy is a low-cost business model, develop programs with their partners such as the Moffitt Cancer Center, Cleveland Clinic, the Wistar Institute, the Department of Defense, and the National Cancer Institute. And look, what they're doing is out of licensed programs to pharma for late-stage clinical development and commercialization as well. And to keep their overhead and cash burn low, they're doing this in a smart way. They're only burning approximately $6 million a year, which is extremely low. And here you can see their product pipeline in phase 1 and phase 2 right now. They have their breast cancer vaccine and their CAR-T, their ovarian cancer and other solid tumors program. That again in phase 1 with the Cleveland Clinic, Department of Defense, Moffitt, and Wistar. And coming is their vaccine for ovarian cancer that's currently in preclinical stage. They have a little over $27.7 million in cash and short-term equivalents. They're burning around $5 to $6 million a year, giving them 4 years of cash runway. So what's nice is they're not looking to sell stock. They're not looking to raise cash. They've got about 31 million shares outstanding. And here's a key point: absolutely no debt. And what's coming, of course, later this year is we should be getting some data released from phase 1A on their breast cancer vaccine, and then as well in the 1B phase, some preliminary data release on the enrollment side, and on their ovarian cancer CAR-T, a periodic data release coming again on the second half of this year. Now let's take a look at their stock. Well, now the nice thing about Anixa, they've been around a long time, so we got a lot of history on them. And here we're looking at the weekly chart. We're going back to the maximum weekly chart, and down here I've circled points on the relative strength indicator, or RSI, where it's either stock is oversold or near oversold conditions, and right now it is near oversold, and that usually presents an opportunity. I want to point out on the weekly though, the volume profile sitting right here at 273. Stock at the time of recording was hovering just around $3 a share. We've drawn in some, of course, supply zones here. Let's take a deeper look at where we think a move could be to 65% to the upside. Now, what I want you to see is when the stock trades between $5 and $3 a share, now we're looking at the 2-year chart, it makes rapid moves between there. You'll notice very quick. So the supply zone, the buyers are around 3, and then below that around 275 as we looked at the volume profile. Sellers happen to be somewhere around 5 and higher, suggesting that if we put in a bottom here, if Anixa does and stock moves higher, well, you do the math, a $3 price up to a $5 sale. There's your 65% move higher. And here's what we can see. Of course, sellers have been dominating around $4.35, as well as buyers right below that, suggesting that this could be a nice supply zone for an entry point with a move up to $5. That is your price target on the bottom up to the upside, and there's your move. There's your case for a 65% move to the upside. As with any of our sponsors, you're under absolutely no obligation to purchase their shares. Do your own research before buying or selling any stock featured on this show. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.